All right, why don't we go ahead and get started? So my name is Mark Lamonic. I'm the product manager for Morningstar Premium, morningstar.com.au. So for people who've tuned in before and that we're not here on Tuesday, Will is out this week. He's out in Victoria, hopefully having fun. He'll be back next week and we'll have the other camera set up. So I'm faced the other way and we've got our crappy room camera instead of Will. So a little bit different today. But anyway, first, our housekeeping items. Well, we're going to talk about portfolio construction today, constructing a portfolio. But housekeeping items first. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. That's number one. Number two, if you are in New Zealand, you should know a couple things. You can go to our website, morningstar.com.au, and you can find our FAP. And also, you should go see a financial advisor if you have any questions about personal advice. Okay, so we're going to talk about goals-based portfolio construction. So that's one exciting topic of the day. The other exciting topic is Shani got a haircut. And the person who cut her hair said that she looked like an assassin. So I don't know how to take that. Shani took it by saying that's the look I'm going for. So yeah.
Don't cross me.
Don't cross you. I learned not to cross you a while ago. All right, here we go. So as I said, goals-based portfolio construction. Oh, one other thing. I would love questions. So ask questions if you have any. So we're going to bounce back and forth between PowerPoint and the website today. So I've done this topic a couple times before. It's generally, I think, fairly popular. Also, if you have any questions or thoughts that you don't want to share today, you can email me. So that's my name. My email address is mark.lamonica1@morningstar.com. It's on this registration page as well. All right. So goals-based portfolio construction. What does that mean? It means we're going to start with a goal. So we've got this little saying at Morningstar that we are about the investor and not the investment. And what does that mean? It means there are all sorts of different investments. Good or bad is only in relation to what you're actually trying to accomplish. So we want to start with you. And I've been seeing these things a lot lately. There's these Facebook discussion boards where people are now taking pictures of their portfolios and putting them up on Facebook and then asking people, what do they think? Which I always sit there and say, that's a ridiculous question because obviously I don't know anything about you. How can you have an opinion on somebody's portfolio and you don't know what they're trying to do? But that's why we're going to start with you. So you need to define your goals and write them down. Writing stuff down is important. So what do we need to define? When we say define your goals, it can't be some goal of I want to be rich. I want to have a great retirement. You need to get very specific. So how much will your goal cost? Very important. You need to figure out how much it will cost. And we'll go through some examples of how you can do that. And of course, you need to remember inflation. When do you want to achieve your goal? So if you have some strange goal of I want to be rich, you need to figure out what rich means in question one, and you need to figure out when do you want to be rich? How much have you saved for your goal? So probably not people that are tuned into this webinar, but you need to go out there and gather statements, figure out how much money you actually have in different super accounts you may have or other different accounts. And then how much can you save in the future for your goal? So you need to define that as well. Yeah, we have a very tongue-in-cheek comment saying, what's inflation? Yeah, anyone who's been watching the market the last couple of days is probably getting reacquainted with inflation. All right, so let's go through an example. So this is where we're going to go back and forth. So we're going to use a real example here. And the example is I want to retire in 20 years and take 70% of my current income of $100,000 out of my portfolio on an annual basis using a 4% withdrawal rate. Let's go through some of the terms that are in there. All right, so good thing. We know what the goal is. We want to retire. We know when it's going to happen, 20 years. Now, 70% of my current income of $100,000. Now, why did I take that approach? I took that approach because that is generally easier for people to think about. It's easier for people to think about a dollar amount per year because that's how we've been trained through our whole lives when we're on salary, than thinking of some hypothetical portfolio value that is supposed to support you. And we'll talk about how we can work with this. So Why 70% of my current income of $100,000? This is obviously all up to you, but a lot of the retirement literature talks about how retirement is actually cheaper than working because you don't have to do stuff. I don't think this applies much anymore, but you don't have to go to the dry cleaner. You don't have to commute to work, all this other stuff. I personally think that's, kind of crap. I would spend a lot more money if I didn't go to work. Days I don't go to work, I spend a lot more money. So I don't really know where that comes from. But anyway, that's up for your own personal circumstances. 70% of the current retirement income of $100,000. Then what we're using is a withdrawal rate. And the reason we're using a withdrawal rate is because that's how we're going to translate the amount of money we need per year, in this case, $70,000, to a portfolio value. So that's why we need a withdrawal rate. So very quickly on withdrawal rates, the 4% rule is pretty famous in investing. So there was a financial advisor in California, came up with this in the early 90s, saying a 4% withdrawal rate was considered safe for a 30-year retirement, given historical market returns. So there's a lot of reasons why that 4% rule may not work, but that's a whole different webinar. So we're going to use 4% rule. Okay, so what do we do first? Inflation. So we talked about inflation. And as was pointed out with the question, we've all been hearing a lot about inflation if we're actually following the markets. We're going to do a special podcast on Monday about inflation that Shani's been writing today.
If I get it done.
If she gets it done, who knows? She might take her new assassin haircut out on the town and not finish her webinar or her podcast script. Anyway, so what's inflation? Inflation is obviously how the purchasing power of money declines over time. So if you are looking at a goal that is far out into the future, you need to include inflation. Now, 2.2% is what we're assuming in this example. Now I'm going to go to the website and show you how some of this works. So, first, $70,000 a year, 2.2% inflation for 20 years, and we've got a calculator that can help you with that, gives you $107,000. So your $70,000 that you want today, you need $107,000 20 years in the future. So then all we have to do, once we know what we need, is divide that by the withdrawal rate, and that gives us our portfolio size. So there's our retirement goal of $2.7 million. You're 45 years old, you want to retire at 60, so that's 20 years. You've got $450,000 in your portfolio. So that's what you're starting from, and you can save $7,000 a year. So those are all the inputs we need. Now, why do we need all these inputs? Why is it important to go through this level of detail? It allows us to calculate the required rate of return. And I'll show you a good way of doing that. What we're doing here is we are trying to figure out what return we need to earn every year in order to hit our retirement goal. And this return, of course, is the average return that you're supposed to earn every year. But that's what we're actually looking to achieve as an investor. That number is really important. So let me show you how you do this. So right here, basically, if I calculate all of this, we get a required rate of return of 8.6%. But I'll show you a way that you can do it using premium. As soon as I figure out how to do that. Not how to do it, how to switch the screen. All right, here we go. We're on our website. I'm going to track investment. I'm going to rate of return calculator, which we were just talking about. So the first thing we can add up actually is we have a portfolio projection tool that can obviously project your portfolio. But if you want to do the math for that inflation calculation, I can just do it here. So 20 years, $70,000. That's basically our number right there. But let's go back to portfolio projection tool. So I can create a goal. All right, so let's go through our goal. We said we have $450,000 now. And we said that we wanted basically 2.7 million. That's 27 million. 2.7 million. Now, I don't need to put in an inflation rate because I've already used that inflation rate to calculate how much money I want to take out of my goal. Then I said on an annual basis, I'm going to save $7,000 a year. And then I said, we have a time horizon of 20 years. All right, so what has this done for me? It has calculated this required rate of return. So that's what I need to get to my goal, given my current savings rate, given the amount of time that I have. And that's a really important number. So let's talk about why that number is really important. Number one, the first thing you get from this number is this achievable? If your minimum required rate of return is too high, you're not going to achieve it. So if I wanted to retire in 10 years instead, all of a sudden it's 18.8%. You're not going to make 18.8%, despite what everyone who started investing in March tells you. You're not going to make that much a year over any sort of long time period. That's why we give you a little warning saying, hey, you're probably not going to make it. You need to adjust your inputs. So the advantage of doing this is you can see if your goal is achievable, and you can also figure out what it would take to achieve your goal. So I could sit there and say, okay, I can't make that. I could save more money. I could, I don't know, get my hair cut less. I need to get it cut even more less. But basically, you can keep going and figure out what exactly is achievable, and this thing will keep automatically calculating for you. So that's the first part. There we go. I just have to save $120,000 a year. Too easy, right? But we'll go back to the original goal. So that's what this allows us to do, and that's why the required rate of return is important. The next thing the required rate of return allows you to do is figure out your asset allocation. And this is where we're talking about building a portfolio that is designed to meet your goals. So asset allocation is simply the mix of assets that are in your portfolio. And at a high level, what we're looking at is a difference between growth assets and defensive assets. So growth assets, think stocks, listed property, things of that nature. So they should have a higher expected return, but they also have higher risk as measured by volatility. So that means your portfolio is going to bounce around more. Now, defensive assets, think fixed interest, think cash. You're getting lower expected returns, but you're going to have less volatility. So they're not going to bounce around as much. So what this number informs is the type of portfolio you need, the asset mix you need in your portfolio to achieve your goal. That's another reason why all these people that post their portfolios on Facebook don't know what they're doing. To put it nicely, if I need to achieve a 2% return a year, then why would I go out there and invest all my money in very speculative, risky assets? I would have a more conservative portfolio. So the portfolio is not good or bad. It is good or bad for you, given your own personal circumstances. All right. So now we've calculated our required rate of return. So we're going to go back to the PowerPoint. I'm really bad with this stuff. So look at that. All right. Same thing we were talking about. Here's all the inputs we put in, 8.6%, 2.7 million. This is the time value of money formula that's just been rearranged. So if you want to go calculate this yourself, you can. The other thing you can do, and we did get a question saying, is that calculator for premium members only? It is, but you can take a free trial, Scott. But the other thing you can do is, of course, I like our calculator because we tried to make it very, very investor friendly. But if we go back to the internet and we just Google financial calculator and we go to calculator.net, we can do the same thing. You can also go buy a calculator over there. So a financial calculator, like the TI-82 or something like that. All right, so this is a little more complicated and less investor friendly, but I'll show you how to do it. So if we go here, this is basically going to calculate the same thing for us. You put the same things in. So number of periods, that's number of years. It could also be if you're saving quarterly, the number of quarters. It gets a little, as I said, complicated. Present value is how much money you have now, $450,000. Periodic payments. So that would be the $7,000 you're saving, and it needs to be negative, but it's because calculators are a pain, except for ours. Future values, of course, what you're trying to get, you'll calculate that same number for you. So you can do that. You can also do this by hand, obviously, or in Excel, if that counts as by hand right now. But yeah, there are other ways you can do that calculation. Okay, let's go back to the PowerPoint. Now, why do we want to calculate a required rate of return? Well, we want to calculate it because it also enables us besides all the other good reasons, it enables us to track how we are going towards our goal. One of the biggest problems, particularly with young people, is don't give me that look.
You gesture at me.
I did not gesture at you. Shani is a year or two younger than me. One of the problems, I think, especially with young people that are saving, is that your goals seem very, very far away. And I think because of that, people give up. And the reason is because the dollars in your account, that's not going to be a linear journey to your destination. What that means is because of compounding, because we are earning returns on returns, when you are young and starting out, investing and saving, it seems like you're not making any progress, right? So if you set a goal for $1 million, even if you don't have to earn that much of a return, it doesn't seem like you're making any progress because your account value is only going up a small amount every year. And I think that that causes people to give up because they don't realize, because of course with compounding, that from a dollar figure, you're getting all of your returns in the last couple of years before you achieve your goal. So I think the required rate of return is good because it allows you to track progress. All right, so here's a scenario. Now, I first did this during the COVID market drop a long time. Julie's here. She's just arrived. Welcome, Julie. I did this during March 31st, 2010. So Shani's laughing at me. All right. Shani's in a bad mood today, so I'm trying to make her laugh. All right. So we went back to the past. Now we're moving to the future. So let's say back then in 2010, when you first defined that goal, I should say 2020, but anyway, it doesn't matter. 10 years later, you went and you invested in the Vanguard Australian Shares ETF. All right. So you've got a basket of Australian shares. So what return did you earn over that 10-year period? Well, you earned, and this is when I actually did this back during the COVID drop, you earned 7.58% a year. All right, so that's pretty respectable, right? The problem is, of course, you know this now because you calculated your required rate of return. You are falling behind. So for a decade, so for half of the period of you trying to get to retirement, you have earned a return, an average return that is below what you need to achieve your goal. So what does that mean? It means you can recalculate your required rate of return, which will prove that you're falling behind. So what has happened? Your $450,000 portfolio is now over $1 million. So I guess that's great, right? So you're a millionaire, you're happy, you think everything's going well. Then you look at the required rate of return, your goal hasn't changed. It's gone up from 8.6% to 9.6%. So that's not great. You now need to earn an even higher return going forward. Now I'm going to go back to the website to show you a way you can do that. I obviously can't go back to 2010 and do this. So I've set up a little bit of a dummy portfolio, but it's only going from November. All right. So this is a different return. Obviously, it's a different scenario, but we calculated 9.81% return. We linked it to a portfolio. And the portfolio, of course, is the way that we are going to measure progress against this. So that includes obviously any money you put into your portfolio. So we had in our situation a goal of $7,000 a year. In this case, there's zero additional investment, just an example I set up. So you're putting in $7,000 a year, and of course, you're getting returns on that portfolio. So two different things are going to happen that change this calculation. There's going to be a fluctuation in your present value, the value that's in your portfolio. And of course, the time period to achieve your goal is going to get shorter. And so what this automatically does is there's your original required rate of return and then your current required rate of return. So in this case, the required rate of return is coming down. And that is a good thing. That means I am ahead in terms of achieving my goal. If it went up, I am behind. And the reason we want to do this is because it will inform decision making. So in this case, we have a pretty small difference. But here's how this could actually impact you. So if you are ahead and significantly ahead after a decade, then that's an opportunity for you to start taking risk off of the table, right? You don't need as aggressive of an asset allocation because you're actually ahead and your required rate of return is going down. The other thing that can tell you is that perhaps the market is overvalued. So the reason that your required rate of return is going down is because the market has done so well. Sound familiar? And then you can once again take risk off the table, and you can actually kind of rebalance out of potentially overvalued securities into cash. The other thing, of course, that can happen, or fixed interest. The other thing that can happen is your required rate of return. If the market drops significantly, your required rate of return will go up. Now, what is that telling you to do? It's telling you to take on more risk, which is good because that's what you're supposed to do when valuation levels drop. Problem with most investors is that intuitively they understand that you want to buy low and sell high, but nobody does that. So they buy high when they're hearing about how all their friends are getting rich with Bitcoin, and they put money in then, and then they get really, really scared when the market drops and they sell. Focusing on this required rate of return, it will tell you, because it's kind of a contrary indicator, it'll tell you what to do. If it keeps getting higher, you need to take on more risk. And that's what you want to do when there are lower valuation levels. All right. We'll go back here. Okay, so this is an example. So now it's 9.6%. You're falling behind. You know that. What do you do? Well, you've got a couple different options here. And because this is just math, all we're doing is we're rearranging the formula. Remember algebra? It was fun where we got to move stuff around. It wasn't fun for me. I was really bad at math. But we have a couple different options. So the first option we can do to get us back to that required rate of return that we were originally, the first option is we can save more money, right? So that's one of the levers we can always pull as an investor. We can save more money. So you can up your savings from $7,000 a year to $22,000 a year. Now, that is probably pretty difficult for most people to significantly increase your savings that much. But in a different example, maybe it's just an opportunity for you to save more. You can delay your retirement, right? Because time is our friend as investors. That's why we want to get started early, because you can't get time back. Personally, I've been told I'm going to die in 3 years. So I have very little time left. But you can delay your retirement. So you push your retirement back by 14 months, and all of a sudden you get back to that original required rate of return. Here's what I was talking about before. You can invest more aggressively. So that, of course, is an option. That's what we're talking about, going further out on the risk spectrum, and that's a good thing to do when the market has dropped. The other thing, of course, you can do is reduce your retirement goal by $350,000. So that's another option, one that probably isn't that palatable for people, but you have to do something in order to get this back to your required rate of return. All right, so look at that. We got through all the slides. So there's some other stuff I'm going to show you on the website, but why don't we answer a couple questions, since we seem to have questions. Oh, that's just Julie saying she's arrived. Okay, so we've got some good questions. All right, so we got a question from Nancy. How much do we need to have for retirement in 2031 based on an average lifestyle, like $50,000 in cash to spend each year? Okay, so maybe we can just show you how to do that. So let's say you need $50,000 in cash and you want to, let's do another example. So $50,000 in cash. Let's say you're doing a 4% withdrawal rate. I'm doing this on a calculator, by the way. All right, you need $1.2 million, $1.25 million. All right, so $1.25 million. Now that does not include inflation. So I'll go back to this. I'll go back to the screen, and we can do this without inflation. So I'm going to set another goal. So I'll go back to track investments. I'll go to rate of return calculator. All right, so we said we need $1.250 million. All right, I cannot type. Now, you didn't tell me how much money you have now, Nancy, so let's assume you have $1,000. This is going to give you a high required rate of return. Now, we need to use inflation, of course, because we didn't, in this case, we didn't account for inflation with that $50,000. So I'm assuming that Nancy's talking about $50,000 now. $100,000. All right. Nancy says we are starting with $100,000. Let's see how many zeros I typed. Oh, look at that. All right, so let's assume we have Why does this keep going back to 240,000? All right. This is frustrating. All right, we're gonna say $260,000 because I don't know why that won't let me put that in. I'll have to talk to the tech team. All right, so we're assuming inflation now. So what does that mean? Well, this is going to take 2.2% a year. Now, when did you want to retire? 2031. So you want to retire 10 years from now. All right, so if we assume 2.2% inflation, we want that same purchasing power that we have today. In this case, we need now a little over $1.5 million. That is giving you a very high required rate of return. So that I would say is not achievable. So what we need then is we need to, of course, save, and we can add in a savings amount in there. But that's how you can use this calculator, once again, to figure out, okay, what are we trying to get to? And so once again, on my calculator, I just divided $50,000 by 4%. And that's what gave me that 1.25 million. All right. So let's go back and answer other questions. Okay, we've got a easy question. Is there a way of going back to a recording of the session if we don't want to if we want to refresh? Yeah, so there is. So we've got previous ones on YouTube. We'll put this one up on YouTube next week. We just need Will to come back and work his magic. But if you want to see, I've done this session a couple of times before. So if you send me an email, I can send it to you. But we've got them on the Morningstar Australia YouTube account, and it's better video quality. Not that it makes me look better, but Will shines lights on me and stuff like that. So it's exciting. All right, so we've got a good question from Vince. I'm already retired and living on income from my portfolio. How does this seminar apply to people like myself? Okay, so I think there's a couple different things that we can talk about. So what do you do when you actually hit retirement? Well, one thing is retirement can be the goal, but then of course you need to live the rest of your life in retirement and figure out what you're trying to accomplish. So you can do the same thing with that calculator. Just because you're in retirement and withdrawing money from your portfolio doesn't mean you still don't need to earn a return. So a lot of people look at retirement in terms of different phases. I know that a lot of people, obviously now is not a great time to do that, but think about when they're younger and retire, they're going to travel more, then they're going to need a certain amount of money for a next phase of their lives. You can include all of those different considerations as well. We did a webinar, and if you email me, Vince, I can send you the link or go to our YouTube site. We did a webinar 2 weeks ago, something like that, on retirement and transition to retirement. So maybe that would be helpful as well. Oh, here's a really good question from Paul. Where do we find on Morningstar what the recommended asset allocation is for a balanced investor? And is this updated? Okay, let's go back to the videotape. That was like a Monday Night Football reference, I think, which I'm probably the only one that's ever seen. Monday Night Football. They play professional football on Monday night. It was a big deal. NFL, Shawnee's into Formula One. Not happy with me. All right. So we have this asset allocation model on here that does have a number of suggested different asset allocation models, all the way from, as you see, conservative, all the way up to aggressive. So if I go in here, I can see what we're trying to accomplish here. All right. So aggressive, it will show you if we go back, what am I looking for in aggressive? All right. So we've got a time horizon of 9+ years. What are we looking for? CPI plus 4% at least. So CPI is inflation. So basically, we want to earn 4% above inflation. So if that looks good to you, we have a suggested asset allocation. So in this case, this would be 90% of your assets. So this is aggressive. 90% of your assets would be in growth assets. So you can see here, Aussie equity, international equity, listed property, infrastructure, and then we have 10% in fixed interest and cash. So that's an example of asset allocation. Of course, there are 5 different models. You can go look at what one works for you. And then let me show you one other thing. Then we're not really getting into it too much right now. Then you can go in and look at your investments. So if I want collective investments, actively managed, ETFs, we have all these same asset allocation buckets. So you can go in there and figure out, okay, I was told that I need, I'm forgetting the number, 30% in Aussie equity. Let's look at Aussie equity. We can see what's rated highly for us. New funds, ETFs, passive, active. So all sorts of exciting stuff there where you can actually find those investments. It's almost like we're trying to put together a website that works. Okay, almost. All right, so another really good question. So how often should you track the progress in order to make informed decisions in a timely webinar? Okay, so we don't want to do this too much. So you don't want to go in there and look and make decisions on your portfolio based on small fluctuations. So when I would say you should go back and look at that, most frequently, probably quarterly. But then be careful about, you don't want to rebalance too often if that's what you're actually using that for, just because there's taxes and transaction expenses. So yeah, you can go in and look quarterly or look whatever you want, just don't do anything. So we obviously want to do less as investors because bad stuff happens when we do things. The other time I think it's important to look at that is if there's a lot of volatility in the market. Because that's obviously a time where people get very, very concerned about what's going on. It's a time when people make bad decisions. So going and looking at your required rate of return, once again, even though your portfolio is dropping and we get in this like preservation mode where we're all scared, we need to sell everything because we're going to lose all our money, going and looking at that can tell you, no, my required rate of return is going up. So me going to cash is not going to benefit me in any way. I'm never going to achieve my goal if I stay in cash. And one of the things that I think, Shadi has said to me a lot and shared with me a lot about her friends, of course, are smart and turn to her for advice about investing and frankly, every other part of their life. One of the things that she says her friends struggle with, a lot of them have developed really good savings habits, but they struggle to sort of take that leap and start investing. And I think the nice thing, once again, looking at a required rate of return, is it becomes very obvious that you are not going to achieve any of your goals by just saving and putting money in the bank. So you do need to invest if you have longer term goals, unless you're saving a lot of money. You really do need to take that plunge, and the risk, of course, the reason that her friends and Shani herself are sacrificing and saving money is because they want to achieve a goal. If there's no chance of them achieving a goal, then what's the point, right? So the risk then is not investing, not having to deal with volatility or dealing with volatility is not the real risk. The risk is not achieving your goal. Okay. Let's see. All right. So we've got a question from Lisa of Alpaca fame. I feel like you didn't ask a question on Tuesday, Lisa. I don't know if you skipped out on us. All right. So Lisa has a question about rebalancing a portfolio. Okay, so let's talk about it. There's a couple different ways, of course, to rebalance a portfolio. So when we are looking at a required rate of return, in terms of rebalancing, what I'm talking about there is just making sure you have the right asset mix at a high level, right? That you are investing aggressively enough to achieve your goal. The other side of rebalancing is that after you've decided, oh no, I feel really bad, Lisa. I'm sorry. Jeez. We'll keep that private, but I'm sorry. The other side of rebalancing, of course, is when we're rebalancing amongst asset classes. So that is a situation where, and those of course fall in that growth and those growth and defensive assets. That's a situation where we've set our asset allocation, and because of market movements, your portfolio is deviated from that asset allocation. So the two recommendations that people have in terms of rebalancing is, number one, do it once a year. So basically what that means is that if you want 45% of your assets in global equities, 30% in Aussie, all of a sudden it's out of whack. That's an opportunity for you to rebalance and get that back in line. So you can do that once a year. Once again, we don't want to do it too frequently because of taxes, transaction costs, everything else. The other thing that some people do is they set a percentage. They will wait till it's a certain percentage out of line with their asset allocation. They'll rebalance then. The problem with that, of course, is that if you have sort of accelerated market movements, that can happen a lot. So if the market is falling significantly, we look at what happened last February and March, market fell far very quickly. You could have been rebalancing over and over again if you had that rule. So obviously, like any rule, you need to think about what you're actually trying to accomplish. Okay, so this is a good question. So Vidania says, isn't rebalancing your portfolio on an annual basis inconsistent or incompatible with the Buffett principle of holding your investments for the long term? Okay, so all we're doing there is we are looking at the mix of investments that we have. And there's lots of different ways to rebalance. So if you are a younger investor and you don't have as much in your portfolio and you are still saving a good amount every year compared with your portfolio value, then you can simply rebalance by directing your money different places, right? So in that example where you've got Aussie equity and global equity, and let's say global equity goes up more or down less than Aussie equity, well, you can start directing your new savings into Aussie equity to try to make up for that. So that's one approach you can do. I don't think that's necessarily incompatible with sort of Buffett's approach. So Buffett does one thing and says another. So he was just talking at their recent annual meeting about how he thinks most investors should probably, at least when they're starting out, invest passively. So certainly rebalancing passively is not going against that principle. It's just making sure that your portfolio remains where you want it to be between on a risk perspective. All right. So we don't have any other questions, Shani. What do you think about that? She's happy because she's sick of hearing me talk. All right, so I will show you one more thing on here that will hopefully help, that I did show you quickly before. So if there are other questions, get them in. If not, we will end early and I will go get a Coke Zero, which is the highlight of every one of my days, which is pathetic. All right, we'll go back to track investments. The other thing that we have in here is allows you to do this the opposite way, this portfolio projector. So we can do the same thing, right? If we have $450,000, now I don't like this as much as the rate of return calculator, but I used to play with this all the time. Not this specific one, but you can't laugh at me. So I use a calculator to play around with different scenarios. Shani dressed like Harry Potter when she went to school. So who's the loser here? 20-year time horizon, and she may or may not still have Harry Potter slippers. We were saving $7,000 a year. I've discouraged her from wearing them to work, just so her teammates don't beat her up. We have 20 years. That's rate of return. So what do we have? All right, so this is basically giving us the same number. Now, this allows you to put in inflation. This is what I like about inflation. This is the opposite inflation calculator. So that's the number we had originally in that PowerPoint, that 2.685 million. What this allows you to do is, if we say 2% a year for inflation, it allows you to look back at, okay, my portfolio may have $2.68 million in it, but the value in today's dollars is 1.8 million. So it sort of allows you to take inflation the opposite way, which I like, but to be fair, I was the one that wrote the requirements for that. All right, so, okay, so really good question from Chris. Chris says, in the aggressive portfolio construction portfolio, so that asset allocation and aggressive, it said that international equity was 50% hedged. What does 50% hedged mean? Okay, so hedging is, well, in this case, what we're talking about is you are hedging away currency. So you're removing currency risk from that international investment. So anytime you invest internationally, if I'm in Australia, which I am, and I'm buying a US stock, what's going to happen? Well, I got to trade my Aussie dollars for USD. Then I buy the share. Then presumably when I sell it at some point, I take my USD, I trade it back into Australian shares. So where's my return going to come from? It's going to come from the return of the underlying security, and it's going to come from changes and fluctuations in the Aussie dollar, US dollar exchange rate. So what does hedging do? Hedging removes that risk. And the next question will probably be like, how do you do that? Well, it's very difficult to do it on your own, but you can buy funds and ETFs that are hedged. So if I go back to Discover Investments, so let's say I want, what did I want? Actively managed fund for, we'll say global equity. All right, let's go passive. Passive will be easier. All right, so I can go in and look at the list and see what our analysts rate highly, and I'm assuming this is going to work. Okay, so here we go. Vanguard International shares hedged. Vanguard International shares index. That is the exact same, in this case, what are we looking at? Funds. That is the exact same fund, but one is hedged. That top one is hedged, meaning they are removing the currency risk. So you're not going to get currency risk fluctuations. You are just going to get the return of that underlying investment. Here we've got a small companies index hedged. So you'll see this all over the place. And if you go and look at any of our funds or ETFs, we'll do ETFs now, as long as you're looking globally, you're going to start to see that. And they put it obviously just in the name. So now we're looking at actively managed ETFs. That H, that Magellan Global Equities Currency H, that means hedge. They're removing that currency risk. So that's an opportunity for you to go out there and use an ETF or a fund and choose to hedge your currency. All right, so we've got a question from the anonymous attendee. What is the best place to find basic information about how to understand Morningstar reports on shares or ETFs, et cetera, how price to sales is calculated? Yeah, that's a good question. The price to sales thing is pretty specific. So I can go back and if you email me, I can get you that calculation. But if you want to understand how our reports work, you can I'll go back to the website. And because today is all about Shani and her hair, or I guess now lack of hair, right? She's not bald, by the way. This wasn't like a Britney Spears moment. So there's Shani when she had longer hair. You can go in and look at these guides. So we have a guide to fund investing that Shani wrote that is pretty good. If you scroll all the way down, she will talk about, geez, Shani, this one's long. So basically I'm going through it now. She's talking about how we actually, how Morningstar evaluates funds. So the different things we're looking at, price is one of them, performance, et cetera. So you can go through and read about how our methodology works. So we've got that guide by Shani, I don't think this is your best guide. No, I think it's really good. I think your best guide is this one, Morningstar Guide to Selecting Investments. I really like that one. I also like her women's investing guides. So I do really like those. But anyway, if you want specific security related stuff, there's an ETF investing guide I wrote and a share investing guide I wrote. And by the way, this portfolio construction guide walks through all the steps I went through today. So that was a good question. All right. So, okay, so we've got a question saying, going back to the hedge unhedged issue. If one is bullish on the US dollar, saying the US dollar appreciates over the Aussie dollar from the current exchange rate, which would benefit me, would unhedged make more sense? All right, so let's talk about this. If you are investing in foreign currency, or if you're investing in foreign securities, you always want the country you're living, the currency, your home currency, in this case, Australia. You want the Aussie dollar to get weaker. Which is what you're saying. You're saying US dollar getting stronger, same difference. So you always want, as an investor overseas that is investing overseas, you want the Aussie dollar to get weaker in comparison to those currencies. That will add to your return. So yeah, if you have a very specific idea of currency movements, and in this case, it is the same currency movement we're talking about, right? So you're saying bullish US dollar going up, Aussie dollar going down in comparison, whichever way we want to say this, you would want unhedged. So that would add to your return. So yeah, exchange rates are hard because there's lots of different factors that influence them. But yeah, that's what you're actually looking for. So what is a hedge position protecting you from is protecting you from the Aussie dollar going up, which makes sense, right? Because if the Aussie dollar is worth more and you're selling cheap US dollars to buy expensive Aussie dollars, then that's bad for you as an investor. Okay, so we've got a question from Patty, which I really like because I talk about goldfish as well. Apologies, I have a bit of a goldfish memory. You know, the old goldfish swimming around saying, "Oh, it's a castle," and then 2 seconds later saying, "Oh, it's a castle." It's exciting for goldfish, but yeah. Do you mind a quick rerun through the steps using the website to discover the right mix of investments based on the goal setting, so it sticks in my mind? Yeah, so absolutely. So what we want to do here, and I should have been better at this. All right, so we are going to, the first thing we're going to do is we go to track investments. We go to rate of return calculator and we set a goal. So same thing we were doing here, and we come up with a required rate of return. I'll just make one up. All right, you're probably not going to get 900%, but all right, let's try to come up with something reasonable. All right, that's not that reasonable. All right, 8.6. We somehow got the exact same return. Who knew? All right, so now you have your required rate of return. Okay, 8.6%. So what are we going to do then? We know that's the required rate of return. Then we're going to start thinking about asset allocation. What does that mean for asset allocation? Well, in that case, that is aggressive. And I know it's aggressive just because I know it's aggressive rate of return. So what we want to do, we want CPI plus 4 at least, right? So we are looking for a rate of return on the high end of the spectrum. So you go into the aggressive mix. If you come out with something a lot lower, if you need a 2% return, then we can start looking at like CPI plus 0.25%. Then we go into conservative portfolio where you see very little is allocated to growth assets, right? So we've got some international listed property, Aussie international equity. So now we're at 15% and the rest is defensive. So that's really how you're going to use that asset allocation to figure out, or use that required rate of return to figure out where the asset allocation is. All right, so we've got a question from the anonymous attendee, of course, our favorite attendee, saying, is there a place that you can go to calculate approximate annual dividend income? There is, let me find it for you. As part of a Morningstar premium subscription, you get access to ShareSite. Oh, I'm not sharing my screen. It's very unhelpful. I was just talking about how well I was doing too. You know, the more I screw this up, the further away my Coke Zero gets. Are you going to walk with me to get a Coke Zero? Okay.
I'm just going to need a computer, obviously.
Shai's been complaining about her computer. It makes this weird sound. So I'm in a portfolio I've set up. So you get access to ShareSite. So ShareSite is Australia's leading third-party or leading portfolio tracking tool. One of the leading, compliance is not like leading, one of the leading portfolio tracking tools. So you get a free subscription of ShareSite as part of a Morningstar Premium subscription. So we bring the information back into Premium. This is our portfolio feature, but you can go to ShareSite. So now it's taking me out of Premium, going to ShareSite because I have this free subscription. I'm not as good at ShareSite as I should be, but you can go in there and look at reports. Where's there? So there, you can go in and look at income reports. So that is a way that you can go and look at your dividend income. And they've got, and that's in the past, all right, that's very helpful when you're filing taxes, which we're coming up to. Except for me, I filed my taxes on October 31st. I was supposed to do my taxes and I kept procrastinating. Then you invited me over to have some drinks and I had to do them in like 5 minutes because I didn't want to miss that. That was my tax story. You can go in and look at this future income report by ShareSite. So ShareSite has a lot of great reports. So just once you set up your portfolio, well, that's not good. I don't know what's in that portfolio, but anyway, you can go in and look at your future income. So hopefully that is helpful. All right, so we got a question from Lisa. What if I use an international currency account to hold my transaction results in US dollars while I wait for a good exchange rate? Yeah, no, absolutely. So obviously the only time that exchange rate matters, well, matters two times, right? It matters when you put the money in. So when you are taking your Aussie dollars and translating them into, in this case, US dollars. And then of course it matters when you take it out. So yeah, there's no reason that you have to bring your money back into Aussie dollars until you want to or need to. So the problem, of course, is that if you are entering retirement, you're starting to draw down your portfolio, you will need to take that money out. But yeah, there's no reason that you can't just park it over in US dollars until you're ready to bring it back. All right, we're out of questions. So I think we're going to cut this thing off right now. But anyway, we'll be back on Tuesday talking about, do you have any idea, Shani? What'd you say? Oh, fill in some time. Do you think I have like a stand-up routine that I can go through? Okay, well, Shani's going to tell us in a second what the topic is. Oh, here's a good question. What is the annual subscription cost for premium? So the annual subscription cost is, it depends. If you are a new customer, we will give it to you for $450 a year, and then it does go up after that. It's at $675 right now, which I think is a great bargain. How you doing, Nate? What are you looking for?
It's saying that it needed to verify. All right, wait here.
We've made it.
We've made it.
Shani, this might be one of those Samson things where she just lost her power with her haircut. So
Tuesday, 18th of May is value versus growth.
Value versus growth on Tuesday, which is interesting because we have had in the last 12 weeks, there has been a bit of a rotation, and growth has gone down and value has outperformed by a lot. So that'll be a good one. Anyway, I'll be back on Tuesday. Will will be back with the camera. Shani's hair will grown a little bit more, and we'll talk about value versus growth. So thank you guys for joining.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.